Are you investing in dividend ETFs? In today's video, we're going to be breaking down the DGRO ETF, which is the iShares Core Dividend Growth ETF. Now, when we start thinking of an ETF of this nature, it should roughly be 20 to 30% of your portfolio, exactly where you are with your investing strategy and the 3 or 4 ETF portfolio. Now, when we start thinking about investing by individuals and by institutions, this is dividend portfolio growth of a very large portfolio. Now, this, of course, differs than we see from the SCHD, which holds about 100 stocks. This actually holds 400 plus, and we're going to go ahead and break this down. Now, when we start looking at US companies and looking at a history of consistent dividend growth, this is exactly what it looks like, even looking at retail investors, looking at a reliable stream of income, but also looking for some growth out of here, not just the income focus that we see traditionally with this. So let's hop over, take a look at exactly what this looks like when it comes to this DGRO from iShares. So let's go ahead and take a look at this. So here we have it breaking down. So iShares, again, the core dividend growth ETF, you can see the price on it right off the bat, $63. So it is over double the price that we see of the SCHD. Year to date, 3.89, and this is as of February. So it is doing pretty good. I mean, up almost 4%. I don't know what your portfolios look like, but 4% right now looks pretty good. You'll also know the expense ratio, 0.08. So just 0.02 higher than we see with that SCHD. So again, why the DGRO? Now, these are two ETFs that are compared a lot. Now, it offers low cost exposure to US stocks focused on dividend growth. That is the important part, not just the dividend, not just the income you're getting in there, but also the dividend growth that we're seeing from this itself. Accessing companies for a history of sustainable dividend growth. Again, thinking about this, but also the diversification aspect and using it as a core of a portfolio to seek income. This is the reason when we talk about building a 3 ETF portfolio, that one ETF focuses on growth. One is kind of the core, which of course is the S&P 500 or the VOO. And then the third one that we look is the income seeker. This, of course, is the dividend growth, allowing a lot of these portfolios to put those dividends that are earned right back into that portfolio and growing the portfolio over an extended amount of time. So it breaks down the performance, and looking on this growth of a hypothetical $10,000, you can kind of break it down and you can see that the green line's kind of going up. We've seen a little bit of dip right there. Of course, that was COVID. That was looking at the 2020 timeframe. But looking at our total return, looking right now, as of December 31st, we can actually bump this through January. We are looking at a 1 year of a 19% return. So thinking of 2024, where we were double-digit growth for pretty much everything, that is where you are going to get this caveat. So again, when you start thinking bigger picture, when we look at those big double-digit returns, most of those returns are driven by our big tech companies. We're talking Alphabet, we're talking Meta, we're talking Nvidia, we're looking at Apple. A lot of the returns that we're seeing in the S&P 500, or even, for instance, the QQQM, which I invest in both of those personally, that is where some of these really high double-digit returns come from. With something that is a dividend growth ETF, you're going to have a lot more stability. So when we look at the beta factors, look at a couple different things, there's a lot more stability in here, which of course, it doesn't have the very high highs, but it also does not have those very low lows that we see with traditional investments. Even thinking of the 3-year, we're at 8.26, 5-year 11.57, 10 years at 12, and since inception, which of course I believe was around 11 years when this ETF came online, inception 11.75. So when you think about the past 11 years in the performance in here, with all of the ups and downs in the market, everything else we've seen, it is beating out the regular kind of average 10% return that we're seeing out of the S&P 500. Now, when you start looking back, let's say even the last 100 years, a majority of growth, a big chunk of growth that we have seen in the growth of the stock market itself has come from dividends and dividend growth. Distribution dates, of course, broken down right here. It does it every single quarter. And then we look at the key facts. This is very important because you'll notice the price, again, a little bit higher. Those quarterly dividend distributions that do come out of here, meaning that you're going to get paid at the end of the quarter. if you're doing the drip, so doing the dividend reinvestment, you can actually put that money right back into the portfolio, which is exactly what I recommend. And I'm going to go through my strategy once we kind of break this down a little bit further, because as we continue looking down here, the portfolio characteristics, again, we talked about the beta. Now you'll notice right here, the 0.81 is the beta. And what exactly does that mean? Beta 1 is essentially the index. That is whatever index it is trading. Beta 1 indicates the market itself. So having a lower beta number, the 0.81 means if it is less than 1, it has less volatility than what we traditionally see, meaning it is also going to have a little bit less risk. Now, looking at the number of holdings like we were talking about, 407 holdings. When again, you do a comparison into the SCHD, which is about 100, chasing a lot more yield and offering a lot higher yield when it comes to the SCHD, because even looking at the 30-day yield right here of a 2.30, so it is offering a little bit of a lower yield. However, it has a much higher price, which is the reason why out of these two, traditionally, I do choose the SCHD, and that is where I do hold. Now, of course, the holdings, this is where it gets a little bit different. So when we break it up with the holdings, you can see JP Morgan. So we have the number one that is in here at 3.31% weight is JP Morgan Chase. So looking again at finances, looking at healthcare, we do have Broadcom in here, but then we have Abbrev. As you can see, we have Exxon, couple IT companies that do fall in here again with a holding. Procter & Gamble, Home Depot. So some of the very staple, very traditional dividend growth companies that we see within the United States, but then it breaks it into the sectors. And this, again, is kind of an interesting way to see it, because traditionally finances. So looking at financials, thinking of those larger finance companies like JP Morgan Chase, 21% of this fund. So majority of this fund is in financials, which of course, as rates start coming down, financial services do incredibly well. We used to get a lot more traditional mortgages, a lot more refinances, and a lot more business driven to the financial sector itself. Information technology is the part that I see within this ETF that is going to be the growth part, not only the dividend generation. IT companies, information technology companies usually don't have a very big high yield of a payout because they're constantly re-upping that money into research and development. Healthcare, a lot more stability when it comes to dividends. Same with consumer staples, and then industrial, of course. Those are always going to be around. Some of these, absolutely the staple items we're looking at, like the Home Depots, the Coca-Colas that are the consumer staples that we always use and have always used. Now, hypothetically, if you're looking to invest in the DGRO, I wanted to kind of break this down on Dividend Calculator and show you what I'm kind of thinking here. So we'll zoom this in just a little bit, but looking in here, so a hypothetical investment of that $100,000 mark is going to give you 1,580 shares, as we can see right here. Share price is $63. So like we said earlier, the share price in this one is quite a bit higher than we are seeing in the SCHD. Dividend yield right here, dividend per share, 37 cents. So again, thinking of the dividend yield we have right here on that hypothetical $100,000 investment, the growth again comes up kind of crazy when you start looking at the reinvestment. So thinking year one, you're looking at $2,400. So breaking it down like I always do, mathematically, you're looking at, if you're reinvesting at all, about $200 a month. That's a pretty good return. I know it's $100,000 invested, but a $200 per month return, I know for me personally, can take care of a lot of bills, looking at the cell phone, thinking of the internet bill, things of that nature. And that's where we're using and where we want to get this dividend income and this dividend growth up to. Even looking 10 years later, you've almost doubled the dividends that you're getting out of this ETF, which is very cool to see. Now, of course, when you start looking at not reinvesting the dividends, I mean, right here, you're making 24, right here, you're making 31. That is just great, straight growth that we're seeing with the dividend growth that is estimated. So looking at the balances, even breaking it down here a little bit further, when you start looking at right here, reinvesting, going to make a big difference. $2,371 going back into it just with the drip balance itself. And then, of course, looking at the dividend yield, you can see it's coming down a little bit, dividends per share increasing a little bit. And again, there's no way to really forecast or really know for sure what the next 10 years are going to look like with this. And of course, when you start looking at 10 years down the road, you can see the values that we have here. This, of course, is no drip, But if you're going ahead and doing this, you're almost doubling what you're putting in here. So drip stock value, as you can see right there, around $200,000 just in the stock value with the income coming back in. So again, thinking about the SCHD in relationship to this, 37 cents a share, $63 on the share price. Right now, the SCHD is 27, dividend per share 26. So you can see, even thinking of the share price where I am owning about 2.5, just thinking of the math, and I am holding, look at this, 36 versus 1580. So I am holding a lot more shares of the SCHD than I am for the DGRO. And of course, dividend per share is going to be a lot higher because I hold exponentially more shares. So if you're looking for growth, if you're looking for really the build out, even again, kind of breaking it down mathematically, we can see the growth in here. And this is where the big difference comes in. When you're looking at the annual dividend income right here on the DGRO, we're at, 3,800. Here in 10 years, we're north of 13,000 on that same $100,000 invested. That is the power of compounding interest when you start looking at ETFs and when you start looking at the way these are built themselves. So, all right, guys, so that is going to do it for today's video. Definitely wanted to break this one down. A lot of people had questions when I covered the SCHD. What does it look like from the DGRO? So definitely wanted to cover it. So guys, that is going to do it for today's video. Let me know in the comments what you guys think. If you're dividend investing, definitely let me know if there's any ones that you want to cover. Overall, when you start stacking the DGRO versus the SCHD, it's very evident that the SCHD is a very clear winner when it comes to even the dividend growth that we can see right here. It is substantially higher year over year, a much cheaper, and of course, they do adjust and recast with the SCHD every single year. DGRO, I'm not sure exactly when they do recast, but remember, the SCHD is chasing that dividend yield with about 100 companies where we have 400 plus in the DGRO. So again, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.